Well, if you've ever wondered how someone's tax situation changes when they retire, our next guest will have the answers for you. We're joined by Jamie Golombek. He's Managing Director of Tax and Estate Planning with CIBC Private Wealth. Jamie, thanks a lot for joining us today. The subject of retirement is always something that we talk about here on BNN Bloomberg. It's getting a lot of attention today because one of our people, me, is about 5 hours away from retiring. When I walk out of the office in the early afternoon today, I am a retiree, so it's a perfect time to talk to you. What are some of the things that I and many other Canadians who are transitioning into retirement, what do we need to understand about our tax situation?
Yeah, well, of course, when you retire, congratulations on your retirement. Of course, the first thing you want to do is look at all the different sources of retirement income that you might have. And it might include things like the Canada Pension Plan, CPP, old age security, depending on your income level, whether or not you have a private pension plan from your employer, and of course, withdrawals of your lifetime savings. That could be through RRSPs or RIFs, ultimately through forced withdrawals, and ultimately your non-registered savings and of course, your tax-free savings account. So all of these combined together provide you a source of cash flow to live on in retirement, and some of them are more tax advantageous than others. And that's kind of the discussion that you want to really have with your financial advisor when you sit down to retirement. Gather your sources of income and look at what is the most efficient way that I can take money in retirement to make that last as long as possible.
I think most of us understand that withdrawals from our RRSP into a RIF are taxable, but withdrawals from a non-registered account or withdrawals from a tax-free savings account, they are not taxable, correct? Because you paid tax. That was income years ago when you saved it. It's not income when you withdraw it from those accounts. Is that correct?
Almost correct. So I would say yes. For TFSAs, anything you take out will be completely tax-free. So that's easy, right? With non-registered investments, of course, depending on what you're invested in. Of course, if you invest in cash, savings accounts, GICs, that money is yours. But of course, if you invest in the stock market or in mutual funds or other type of investment products, when you take money from that account, in most cases, you'd have to sell a particular stock or security or bond to be able to realize that cash. And in that case, you could potentially have a capital gain. The good news is that capital gains are only half taxable. So whatever profit you realize on the sale of that particular asset, only half of that will be included in your taxable income, and effectively your tax rate is half what it would be. So I'd say, number one, TFSAs would be completely tax-free. Then I would look at, capital gains, realizing those on investments as needed to withdraw that at only half the tax rate, depending on your cost base. And then, of course, finally, you'd have your RSP, RIFs, and pension income. All of that is fully taxable, dollar for dollar, at your marginal rate in retirement.
Jamie, one of the things we deal with a lot is people who retire obviously much earlier than 71, who are in a lower tax bracket and are reticent to take money out of their RSP or turn it into a RIF early. I usually encourage them to do so because you want to spread out that retirement income over as many years as you can at as low of a tax rate as possible. Could you maybe speak to that strategy and what you think about that?
Yeah, so look, I'm generally not a fan of taking money out of an RSP or RIF, early, simply because you're going to lose a big chunk of that in taxes on the day one. And remember, if you're 65, you could live another 25 years, right? Based on life expectancy tables who are, people who are already 65. So that money could compound for 25 more years. So you have to do a cost-benefit analysis. But I do agree with you that if someone really is in a very low tax bracket, and by that I mean, let's say they're in the lowest bracket, which is under, let's call it $53,000 a year. In that case, it may make sense to do some extra withdrawals, especially if you can take that money and then put it into a tax-free savings account so you can continue to enjoy that tax-free growth, but you'll be able to capture that money out. Ultimately, what you're trying to do is trade off between what is the tax rate at the end of the day. So on death, worst case scenario, you might be in the highest bracket. That could be as high as 53, 54%, depending on your province, or taking it out at the lowest bracket, depending on your province, that could only be, let's say, 20%. So there's a spread there, but of course there's a time value of money associated with having to pay that tax now versus in 25 years? So these are great questions, and we sit down with every client. And when they have particularly a very large RRSP or RIP, we would absolutely consider that strategy.
I'd love to hear how you talk about this subject with your clients. I was surprised a few years ago, I didn't learn this yesterday, but I learned it a few years ago, how much more a person gets in Canada Pension Plan and in old age security if they wait until age 70 versus claiming it right away at age 60. It's more than 40% more that the amount you get in those payments from CPP per month will be 40% more at age 70 versus age 65. How do you have that discussion with your clients?
So I would say this comes up absolutely all the time. I would say Canadians are perhaps obsessed with the question of when do I take CPP. That being said, most people take it at 65. That is the normal age. I think it's over 90% take it at 65. People who need the money obviously would take it earlier, as early as age 60 with a significant reduction. My advice is if you're in relatively good health, like there's no major heart problems or major medical conditions, and you hope you're going to live to over, let's say, 80, 82, somewhere around there, then if you can afford to do it, you want to delay and defer that CPP as long as possible, ideally till age 70. You get 0.6% for every month you delay. So you look over 60 months, you're talking about a 0.7% for every month that you delay. You're looking at 42% more of CPP, and then for OAS it's 0.6% a month, so 36% more OAS. And that's not all, because as some of the commentators have written, some of the actuaries, not only do you get this higher amount of CPP, but if there's wage inflation, the amount of CPP generally will be even higher than that. So if you sort of do the research and do the math, if you can afford to do so, you want to defer that CPP and ideally OAS right up until age 70, if it makes sense. But again, speak to a financial advisor to make sure that advice is appropriate for your situation.